Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
All right, so thank you again for everybody tuning in. I guess put out the poll out there, and folks wanted to maybe get a little chit chat going tonight. So we're gonna do it. Let's do it. We'll so it's Tuesday, January 10th, about 8:30 on the East Coast. Interesting. Well, not really that interesting. Just the S&P went to the top end of the risk range. So we came into the day with shouldn't be surprised with the S&P down 3.3% to the low end of the range, and that just simply didn't happen. So really, at the end of the day, it's not that big a deal. It's just math. It can go to either side, and it can also trade in the middle of the range. So now we just got to kind of go through and evaluate. What's transpiring within the signal. What's the data out there looking like? Has anything changed? Should we be updating our view or anything like that? And the answer to all of those is absolutely nothing has changed. The view remains the same. The data continues to come in a very poor data. Call it. Yeah, so everything's continuing to do exactly what we think it should do, and now it's just a matter of navigating the very immediate term shifts in the price action within really U.S. oriented assets, right? If you go through just a little some kind of numbers here as we get into the conversation tonight, but we got XLK down. Hold on a second. Let me just pull it up. XOK. Sorry, I had it up and then it disappeared. XOK down 2.74% in the last month. XLY down negative 3.24% in the last month. These are all basically percent change moves. The leader of the pack is Energy XLE at plus 7.37%. But you've got crude oil, which is up 4.73% in the last month. But that low end of the risk range on crude, and I'll get the kind of commodities in a minute, but just where I'm talking about energy, the low end of the risk range is almost a new 3-month low. It's basically like a few pennies above the low end. The 3-month low in the look back. But the 3-month high in that look back window is at $92.61, which is approximately 24% higher from here. Or to think about it differently, we are about 19% off the highs of crude. So that's a pretty wide gap in regards to the where we came from just within the last 3 months, and where we then went to, right, and the risk range and what it's indicated, which is basically momentum remains to the downside. So energy's had a huge, I'd say a pretty big bounce here in the last 1 month, because then if you look at the 3-month percentage, it's almost 11% at 10.80. So again, these numbers don't lie, right? XLC, so in there is Meta and Google, Netflix, etc. So you saw Meta on the risk range shift to a neutral signal, and Netflix continues to have that bullish trend. So again, XLC is not necessarily shifting from a trend standpoint. I don't actually have that information from Keith, but it is up plus 3.9% in the last month. So as we talked about last week, and I think it was Brian who mentioned shorting Meta, and that signal is confirming right now at this point in time, moving to neutral, that it's really that there's probably that there's other areas to hunt and better places to be. And the fact that both tech and consumer discretionary remain negative in the last month, in negative territory, I mean, it really tells you right there, as I was mentioning last week on this call, tech continues to have a very, very weak signal. And you're seeing that right now, right? So the risk range today from the daily risk range product that we get on an immediate term basis was mirrored the trend range that we got yesterday for the ETF Pro product. So that should also tell you something in regards to the vol within that asset class within the Tech XLK ETF itself. So again, just kind of keep your eye on what's happening across the board within both the risk ranges on regardless of the asset class. I do want to highlight as well OIH, which we had been short for a a pretty quick minute. That was a great cover by Keith and a signal, because that thing's up 9.83% in last week. So great cover by Keith on the OIH on that portion of the energy, and really energy as a whole, because as I said, XLE has been a leader of the pack here in regards to the traditional or the kind of more core U.S. sectors. But another good one there inside of the portfolio has been GDX. Again, I don't want to kind of just rhyme off all the numbers, but it's important, right? So I'm looking at these on a 1 month basis. GDX up 11.38%. Again, this is a core asset allocation inside of the portfolio. And then another one that would be on the short side would be, regional banks and the kind of small caps or the small to mid caps that live within there, and it's flat on a 1 month basis. So again, just kind of reiterating some of these things, some of the things that are jumping out to me on the page here on a Tuesday night rather than a Wednesday night. It's again, I'm just going to reiterate the fact that it's really important to kind of look across the board and that kind of thing. So crazy enough, as much as S&P, it might feel like it's been up for days on end, and when is it going to go back down? It's still in negative territory on a 1 month basis. So it's down 34 basis points on a 1 month basis, down 16.07% over the last year, and just a measly plus 2.49% in the last week. So definitely other places where you've probably been felt like a squeeze or what have you, but up 2.5%, call it, in the last week. Really isn't much to write home about, given the fact that we remain in the chop bucket, and when you're in a quad 4 environment, those volatility moves can be quite robust. Keith alluded to that on the macro show today, where imagine we had 11% daily moves in the S&P or Qs or what have you that you saw back in 2008. And even I don't think we got quite to that extreme in 2020, but definitely saw a couple of days there. If memory serves, in the sort of 4, 5, 6, 7, 8. I don't know if it was 8 actually, but definitely in those mid single digits, and those are big moves. We haven't quite gotten back to that. We've had that day in that day in November on the CPI or post the CPI. That was, I think, about a 7% move if memory serves. But again, so we've had anyway these moments in time. I think it's really just important to kind of come back, reassess, take a moment this evening to kind of go through the numbers, go through where the price action has been, where we currently stand today, and then look at, go beyond just equities themselves. So if we get into the bond market and really looking at global rates, again, these are 1 month changes, and I'm going to list them off as basis points, but the Japanese 10 years plus 25 bips or 100%. So that bad boy's been a double. The Swiss 10-year is plus 22.44 basis points, and that's been one of the leaders there. And again, that's a very important country, certainly from a currency standpoint. And on the 10-year, it's almost up about 19% in the last month alone. The German 10-year is up again almost about 18.5% or 35.5 basis points. The UK or the Great British 10-year up 11.85% in the last 1 month or 37.7 basis points. The US 10-year, on the other hand, is only up 2.2 bips. And that's about 62 basis points in terms of percentage terms. So U.S. 10-year really doesn't look like the rest of the world, where you're seeing a lot of double digits to low teens to high teens in regards to percentage change, adjustments in the last month. And again, that's with the move here in the U.S. up 2.4%. day over day, and at around 100, 119.52. So again, the move is telling you that nothing's really changing here from a volatility standpoint inside of fixed income world or the rates world, and the global yields are certainly telling you the exact same thing as well. So again, just we are looking through macro across multiple facets, right? We're not just focused in on the U.S. We're trying to assess what's going to be happening across the board here in 2023. It's still very early innings in regards to year-to-date year-to-date returns, et cetera, within 2023. So just keep that in mind. Stay patient out there. The commodities space as well. I already talked about oil, but in regards to inflation and pivots and the Fed pivoting, you're certainly not seeing that from a lot of core components. I mentioned oil earlier, up 4.75% or almost. Copper is up almost 9% last week and 5.5% last month. Gold's up 4.6%. Silver, on the other hand, is looking a little bit differently than the rest of those, or certainly the precious metals itself in terms of and or other commodities. It's only up 83 basis points, and it's actually down 1.34% in the last week alone. So keep in mind, so kind of keep an eye on that silver. It's obviously remains bullish trade and trend, but certainly acting a little bit differently there versus some of the other components inside of precious metals and commodities itself. The ag space, again, this is actually really fascinating to me, right? You got cotton, corn, wheat, cattle, soybeans, all positive on a 1 month basis on a percentage change terms as well. So again, these things are all obviously factoring into your CPI. Now, on a 1 month basis, that might not totally impact what you're seeing from the CPI print that's going to come out on Thursday, because it's only a portion of that funneled into December. Some of this move has happened in the last week, but again, these asset prices and what they're seeing in terms of the Fed, and when they come out with their the FOMC meeting, next month. That's going to start to incorporate all of what's happening within, commodities itself and the inflation. And Powell today was very much reiterated the fact that that is a number one priority for the Fed and getting that inflation rate back down to 2%. So again, just wanted to reiterate these things here tonight. We can open it up to the floor. We got any questions, that kind of thing. And kind of take this any which way. I think tonight we're going to kind of do a little bit of a different style. Obviously, it's all about the notebook. Ran through that there in the last kind of 15 minutes or so. But again, I think just reiterating the fact that patience here, quad fours across the board. You're seeing that globally, or just kind of getting things going here. But yeah, let's kind of open it up. Anybody out there, if you got questions, whether it be implementing the process, whether it be stuff in the notebook, asset prices, what have you, by all means, jump in. Let's get this conversation going. Arthur, my friend.
Hey, Robert, can you hear me?
I can. Welcome.
How you doing?
I'm great. Just got a lovely view of I-95 from the hotel room here in Stanford, and it's I mean, what no better place to be than here talking to my friends on Twitter, right, via Spaces, and talking something that we all love dearly, which is dominating the best game in the world, which is the global capital markets.
Right. So, question on the recent levels sent out on ETF Pro.
Yeah.
High yield and junk seem to hit the break through the top end of the trend range, and I'm wondering if you wanted to comment on that.
Yeah, let me pull.
And when would it? I guess more of a process question. I mean, it's almost. I don't know how Keith. He's got his. His patented IP vast signal, but it looks close to. They look close to going neutral.
Yeah, sorry, I'm quietly kind of looking at that. Yeah, so here's the thing. Each asset class is really going to have like a different kind of parameter as terms of how like the on the look back window, thinking about it in terms of going back in time with in regards to pricing, the price volume volatility metrics.
Mm-hmm.
So something that's lower beta or has a lower or kind of a, I guess, yeah, a lower realized vol component to it. Again, I have not done this myself, but my understanding is that it will take it'll, typically that signal will incorporate a longer duration versus, in terms of like going beyond just like the 3-month window. Let's just say it goes into 6 months or maybe even a year, and I've talked to some folks who've kind of built their own sort of versions of Keith signal. And that's what they've told me in regards to like the dollar in particular, or even, rates. So like global rates and stuff like that, right? So they call it the US 10-year, that kind of thing. So you go back deeper in time. So my point of saying that, Arthur, is that I am pretty positive that if you kind of peel out beyond just the last 3 months, and you look at even just the last year, kind of going back to early 2020, 2022, we came from, call it the 86 level, and we're at 76, right? So I suspect, I don't have that trend level myself, like obviously handy, but I suspect that trend is, I wouldn't say significantly higher from where we are today, but certainly higher from in terms of like not the trend line that is. Now from a trade standpoint, that might be a slightly different situation. We may be kind of flirting with that level in terms of the actual trade line, but I don't have that. So great question, and I think it's really one where it depends on the kind of volatility component of that asset class in regards to like how deep in time, which is another reason why kind of the Doji channels that I've shared right on here and kind of and what have you. That's obviously a static thing in terms of like just a, very much like that's the 3-month look back window in terms of, what you're looking at, versus having it, for me, when I pull that up on HYG, I know I got to go kind of like deeper out in time, beyond that box to sort of really get a better picture as to like where the highs and lows are. So if I kind of look back at the highs there on HYG, again, I probably wouldn't maybe not go all the way back to like August, but those are around, the 79 and a quarter range, right? So, but that kind of like last high there is really kind of like the level that I would say, going back in time in terms of the current risk range, we're like well within what I would consider the kind of longer term look back window, and that kind of thing.
Okay, that makes sense, Robert. Appreciate your answer.
Yeah.
Thanks.
Yeah, of course.
Yep.
You, I think you might get a new nickname of like, HYG. I mean, it's I love the focus on HYG. If something's paying you, why not just really hone in on it and focus on it, right?
Well, it hasn't been paying. It hasn't been paying lately, but I'm there.
Yeah. I mean,
well, Keith keeps talking about this credit event, and that can be. You can look at a lot of different ways to play that, but the short junk, I think, last week gave me a little encouragement. So we're in good shape.
Absolutely. I mean, if you kind of pull up, basically high yield, right, in terms of on the corporate credit side, I mean, the moves there have been quite strong, right, in terms of what's transpiring on a 1-month basis and what you've seen in rates overall. So again, I would, that's another one where the data continues to showcase the fact that things, nothing has changed, right? And really, we're just at the incredibly early days. Like everything that we've talked about in 2022 is really just starting to unfold here in 2023. And I think I talked about this last week. It was in terms of what, or it might have been on the beginner's guide, excuse me, Arthur, in terms of kind of how do you try to filter companies that that could go through a credit default situation, and that's, again, this is just kind of starting to transpire. You're getting folks that need to repaper their paper, right, aka either roll it out another 12 months or whatever it might be, but they're having to do so at rates that are significantly higher than where they were, in negotiations just a short 12 months ago, let alone if they were doing it, 2, 3, 4, or 5 years ago.
Yeah, I think there's going to have to be, it seems like there's going to be a catalyst to do something with somebody to get this market triggered. Because if you look at the data, a lot of the, if you're a good CFO, carrying your weight, you've already done that. You should have been doing that, 6, 12 months ago. And I think if you look at the data, there's not a whole bunch that needs to be recapitalized in 23. 24, it like triples or quadruples. But that's kind of the backdrop of higher cost of capital for the next 6 to 12 months.
Yeah, exactly.
It's there.
Yeah.
They're going to have to do it. I think the market's going to have to look ahead, and there's going to have to be some kind of a catalyst to get the market. I think because I did it at the ETF level, I don't do it at the individual company level. I just don't operate that way.
Yeah.
So we'll see. I just want anybody else have any comments? I'd appreciate it on that. Thank you.
Yeah, absolutely. No, Arthur, always a pleasure having you up. And listen, I mean, this is, currently in terms of the quad map itself, it says, quad 1 eventually there by the end of the year. But, that doesn't necessarily mean that the signal is going to, trade alongside that same quad, right? So, we're in a very unique situation here. And again, in the macro themes call from last week, one of the favorite slides that Keith mentioned, and certainly one that has become my new favorite, is the showing the nuances between basically the drawdowns as well as the intra kind of, I guess, the pops or what have you, right? In terms of what happened in say the NASDAQ, right? And there was a couple kind of 25-40% sort of moves within over a course of a 3-year time frame, but we all know what really transpired from 2000 to 2002, 2003 time frame, and the drawdown that occurred. So again, I mean, I think just to reiterate kind of the patient standpoint, I think we got to navigate kind of the game inside the game a little bit here, right? And HYG, Arthur, it could be one of those things for 2022. And again, I'm not saying this, but like in 2022, HYG might not be the like kind of go-to magnet in terms of kind of on the short side. Maybe it looks something like energy. I don't know. I'm just kind of picking again just from a signal standpoint. But XLE is currently neutral. But if that goes to negative, or even real estate, right? XLRE remains bearish trend. Coach talked about I think housing today, ITV, right? So maybe that again it's kind of talking about or looking at kind of where we come, what's the potential kind of next shoe to drop, and maybe it goes in phases, right, Arthur? It's like HYG was 2022, in terms of like the fixing and what have you. Maybe it's TLT again in 2023. I don't know yet, right? But time will tell. That's for sure.
Thanks, Robert.
Yeah, of course, man.
Yep.
Signal and noise. What a great name. Wasim, thanks for jumping up. If either of you have a question or comment, that's right.
Oh, what's going on, guys?
Hey, Wasim, I'm doing well.
Just a quick note. I'm just wondering if you know how net short Keith finished the day off. I'm not sure if he told you guys, inside the house.
He did not. I know. I think you guys. No, I did not. I did not get his net short position. He'll probably. He said it today. Did he say it on Micro Show today? I think.
No, I think he said it. I
the call.
He may have said it yesterday. I think he said. Actually, I wrote it down. He said at one point he was negative 10. I think he was negative 10 or negative 15. I assume it's
10.
I think he's probably pushing like 20 now, if I had to guess.
Yeah, I mean, given the number of RTAs on the board and the double ups, right? I don't know. I don't have that number yet, but I think it's.
I was just curious. Yeah.
Yeah. And
Robert.
Yes.
Hi. Just to follow up on the previous comments, and particularly on the credit event that Keith is talking about. Do you know how this in the past, or how does it manifest itself in mortgage REITs? What's the impact of a credit event on mortgage REITs? Is that uh, do you have any view on that or historical record?
I don't have the back test handy on mortgage REITs,
Mm.
but yes, no, I don't. I think in this environment, in terms of what we're anticipating, or sort of certainly what we're kind of forecasting, I should say, not really anticipating, but what we're forecasting is
Okay.
higher rates for longer, right? So you're kind of going to see elevated, even the long end of the curve at this point in time, especially where it's remains bullish trading trend. Right, that top end is looking at 4.08% as of this morning. So that's kind of elevated for longer in this high, on the 30. Again, I'm using the 30-year as a proxy, right? So kind of in this, high 3 to low 4 range. Again, just kind of for the foreseeable future. And what we're kind of forecasting is for these rates to be sticky for longer, just like inflation is coming in stickier for longer. So the Fed's going to keep battling that.
If quick comment there
Yeah.
would be, I mean, if there's going to be a credit event or Fed breaks something, well, they'll pivot. That systemically, if something happens, they're going to pivot, which they'll bring rates down. So probably mortgage rates, would get a little more favorable over time. Would be my comment to that, Robert.
Yeah.
Yeah, absolutely. I think like if that does, if the pivot does occur, absolutely, right? That the longer end of the curve is going to come down, and even in a recessionary environment, you see a similar thing, right? Where the bond market will start to price in, kind of that pivot, right? So that's what we were somewhat seeing at the end of December there, or kind of like I guess early December, right? In terms of the 10-year and the overall shift in regards to the signal itself, where it went bearish trend for what now was a hot minute, but that was the anticipation, right? Is the kind of the recession, people pricing in the recession, and therefore pushing down the 10-year or the 30-year yield curve lower, and yeah. So I think if that starts to happen again, you're going to see a similar type environment where the 2-year kind of stays stickier for higher, right? Or the shorter end of the curve stays stickier and remains elevated, while the longer end of the curve starts to move lower.
Yeah, I think mortgage REITs make money on the spread, right, between the shorter term to the longer one, right?
The mortgage, the REITs, right? Is that what you're talking about?
Mortgage REITs.
Yeah, the mortgage REITs. Yeah, the yield curve is correct.
They make the money on that delta.
Correct.
So if the long term stays elevated and sticky, I think that this was Arthur's point. You can make an argument that they should do well, but I don't know about the short term. Okay, thank you.
Yeah, absolutely, no problem. Let's see. You got anything else popping out in your notebook there in Toronto?
Yes, we saw that the VIX went down to like at 20 now.
Yeah, low end of the risk range. That's for sure, right?
Yeah. I think Keith probably will talk about it a lot tomorrow.
I suspect it was a higher low and a lower high this morning in that VIX, and we kind of pretty much landed on a little bit below it. So that goalpost does move, but I suspect it's pretty much right there in the low end, given the fact that the refresh S&P risk range happened to land pretty much right where we close here at 39.19, right? So those two definitely correlate with each other. So again, he's going to be running those numbers tonight, but yeah, definitely keep an eye out on what's happening there. I will say the other signal that I thought was of interest, or sort of that, I guess, popped out on the page, or is of interest as of this morning, was the dollar, right? For the first time, that low end of the risk range is below, the trend level. I have that trend level back from December 20th. And now again, we didn't close below that trend level, but certainly that risk range, low end of the risk range, is below it. and we haven't had that. It's been sort of flirting right around that trend line for quite a while in terms of low end of the risk range. So that signal to me, or that the U.S. dollar certainly kind of pivoted this morning or kind of overnight on Monday night. Yeah, awesome. Jimmy, I see you out there. You got I don't know if it's probably dinner time for you on your side, so if you can't jump up, no problem. But Wasim, yeah, man, what else happened in your world? What are you thinking?
Well, I mean, Europe is. I know we're still waiting on key signal on Europe, but there's a lot that's starting to look from a signal point of view good on the short side that I'm interested in. I'm being very patient on that end though, but obviously Germany, Poland, France, all really primed up for shorting. I think at least. Nat gas is taking a beating. The Vixen is it keeps flirting with the F bucket. It's like, and I'm just that's kind of what I constantly kind of look at that. I know it's not just one thing, but it's it is something that is particularly interesting to me. It's hovering around that high 27, 28 mark. But yeah, I mean, Keith is, again, signaled that, the VIX is making higher lows. So, volatility it's interesting, right? Because it's still, the VIX is very much on the, borderline investable chop bucket. But then the top of the range is right squarely in the middle of the chop bucket. And yeah, and the Vixen is, kind of just about wants to knock on the door on the F bucket. So things could change very quickly, right? And that's kind of why I think Keith is really lining up. He's really leaning on the short side here. But what's your opinion with on Europe?
Yeah, I mean, so Europe, right? The DAX went neutral. Was that Friday maybe? No, Monday. So the DAX went neutral Monday, and so that was certainly something that changed, pivoted overnight, or sort of like this week from the weekend work. But that was kind of you could see it in terms of the it's up 17.2% in the last 3 months. Up it's up a little under 2% in the last month, and but if you kind of go back on a longer term duration, it's still down 9% in the last year, right? So I think it kind of just depends that Europe. The setup right now, the signal kind of doesn't really totally agree, right? I think you're getting, let me clarify that. The trend signal agrees. I think the immediate term sort of like trade signal is sort of, has picked up kind of positive momentum. Again, I'm not going down the line in regards to, each one that you listed, Wasim, but, to Europe, in general, I think is setting up really nicely on the short side. I think they've got more issues to deal with across the board. Again, if we kind of get into a little bit of the narratives here, they've got even worse inflation, right? Yeah, sure, it came down and what have you, but the inflation prints are still up in the call it high 20s range and that kind of thing. So not so is it not only inflation, but like so that's stickier. That's way stickier for longer. And the ECB has been very clear in terms of they have a very much their sights set on 2% as well. So that delta spread between where they currently are and where they're trying to get it to is even worse than Powell has it at the Fed, right? So that to me is a big telltale sign. And then on top of that was I kind of rattled off what's been transpiring on the 10 years across the board that were kind of in three core countries in regards to Switzerland, Germany, and the UK. So you're seeing it in the global rates too, right? So I think all those big piece underlying components there. The equity market kind of isn't really, it's not really, it's having a counter trend move, in my opinion, right? So you're getting some
exactly.
immediate term trade,
yeah.
some trade positivity here. But the other thing too to remember is like kind of looking at, and 1000 FX and I were talking about this yesterday on Monday, just in terms of like the components inside of those exchanges. It is different than what we have here in the U.S. In terms of kind of the makeup, right? So whether it's for instance like France, right, has some more kind of consumer discretionary type type exposure there, especially on kind of high end, right? So like Louis Vuitton Louis Moet, right? So LVMH, they're in the CAC 40, and that kind of thing, right? So I think again, it really just depends on the the exchange that the indices that you're looking at, and potentially why one of the reasons Keith updated his kind of preferred signal strength list, and it was Netherlands and then Italy on the short side, right? So I think kind of that pivot again, going back to my commentary to Arthur, in 2022, it was kind of call it the big boys that we kind of attacked from the short side, right? So the DAX, France, that kind of thing. And now we're kind of going, right now the best signal strength are Italy and the Netherlands. So, look at what's like the underlying components there. The financials, like if you look at EUFN on the ETF side, I mean, it's been nothing. We covered that one in ETF Pro a while ago, and thank God we did, because it's been, it's up on a tear in the last three months. Right off the lows from 14 back up to almost $19, right? So, financials on the European side have absolutely rebounded in the last 3 months. But, with rates elevated like they are, and the economies and inflation and the consumer in their situation, what does that look like, right? Like we are attacking, or, we've added back financials, XLF and KRE on the short side here, within Hedgeye in the last, week or two. Again, the signal doesn't quite agree there with Seam, but I've got UFN on my very short list for, to kind of, once it kind of puts in some, a lower high, to kind of go back to the wood there on the European financials.
Yeah. And I'm actually happy.
And sorry, just to kind of finish up, but then inside of EUFN, you do have a couple Asian kind of, sort of, Chinese type exposures through Hong Kong, inside of that ETF and that holding, right? So this is like it's a good exercise with Seam to really kind of evaluate and reiterate. Like you got to kind of understand what's inside some of these ETFs and what's inside some of these indices, right? Because it's going to influence kind of the signal strength and like where you're hunting.
No, for sure, and that's something I'm actually working on. Is just actually going deep inside each of them and opening them up, and seeing like seeing what's inside and how they're weighted on a percentage basis, right? It's really important to know that.
Yeah, like ITB, for instance, right? Like it's got DR Horton, Lennar, Pulte Group. I think those are the top three, right? And then Home Depot is kind of right in there, and at like I think it's like a 4-ish% position. I'll have to pull it up. So, but it's like the core, it is squarely in the kind of like the Lennar in particular is, DR Horton in particular is its biggest holding, and that signal has been holding in really, really, really nicely, right? So it's kind of like the ITB. That's where the XLY, like the consumer discretion, you get Home Depot in that. You also get Tesla, you get Amazon, so, it's one of the reasons, again, there's a reason why it's been a core short since, throughout most of 2022 for us, and remains so in 2023, right?
Yep.
Yeah.
And I guess the last thing I just wanted to mention was, Keith added Canada EWC as and you know what, I was like honestly like waiting for it. I'm like, man, like, because I keep like I track it a lot, and I all the banks, and I have Josh Steiner's financial sub, and I'm like it just, and I guess now Keith is seeing something in the signal, and I follow all the top 6 banks, and they've been they're still holding up quite well. They've been, lately they've been coming down a bit, but I guess, with everything that's going on with rates in Canada and especially housing, I guess I guess the signal is now telling him something, right, for him to put it in. So that's that's just interesting. That's all.
Yeah, and sometimes it's a little interconnected too, right? Like the Canadian dollar has been pretty weak, and all
Yeah,
and although that didn't make it to like ETF Pro, it's been something that we've been kind of talking a decent amount about in the last sort of month to 2 months, and that the kind of weakness in the Canadian dollar versus the U.S. dollar, and then weakness in oil. And again, I know the TSX is comprised of a decent amount of Canadian banks as well as sort of some energy and that kind of thing, right? So I think as you kind of look at the whole holistic picture here in 2023, again, like kind of going beyond Europe, right, where I think this is a really critical point in terms of the process where adjusting kind of where you're thinking, right, and where you're going, pivoting beyond kind of okay, like this is worked, and I've kept going to the wood there in terms of say shorting DAX, right? Well, now the game's not necessarily it's changed, but it's just the signal sort of pivots a bit, and you're like, okay, well, let's go. We got a global macro component or kind of global macro
exactly.
strategy, right? So
Yeah,
we can go bloody anywhere,
exactly.
So it's just a matter of going to go and find what could work best, and sort of has moved to the downside. And I think in terms of the TSX, right, like it's down 6% last year, but it's up 4.4% in the last 3 months, right, and down almost a full percent or 0.9 basis points. 0.9% in last month, right? So it's like it's just on the cusp, right? Even if it just gives back its 3 months gains, that's a good that can be a good place to go. And then if oil really breaks down with global demand down, and that kind of stuff, and that signal continues to be very, very weak, as I mentioned, in terms of crude. All these things kind of start to snowball on each other, and the dominoes start falling.
Exactly. Yeah, and that's exactly what I'm thinking. I'm like, with oil getting weaker, and and rates and the whole like credit collapse. I mean, like, Canada seems like just like primed for for at least more of a come down than it has so far. That's all.
Yeah.
But
lumber was added as well, right?
Exactly. Yeah. Lumber was down. Yeah, lumber. I think I had what was down a lot today on the commodity: coffee, cotton, cocoa, lumber. Those were some of the big hits today.
Yeah, exactly. Yeah. Cool.
But yeah, that's all.
Awesome, man. No, you're doing a great job. Yeah, go ahead, Signal. And noise.
Robert, I'm from Canada, and housing is a religion for us. Okay, so don't talk too bad about it. Especially, and also our big banks. We have.
I know there's only 5 of them, or there was, unless another one merged. No, I'm just kidding, right? So it's 5 or 6, but it's a different type of environment. Again, this is where going back to kind of understanding or sort of just like even if it doesn't have to be again like Wasim. I know you said you're gonna dive deeper in that kind of stuff, but even just sort of kind of having a very basic understanding as like what is the kind of core components. And we talked about this a little bit last week, or no, we talked about this a decent amount last week in regards to the Russell, in terms of like the different kind of sector exposures that it has. Just having that kind of like brief knowledge, or sort of like very just kind of like high level knowledge, not brief, but like high level knowledge in terms of what's the indices make up of like the CAC 40, right? Or what's the difference between the the FTSE 100 and the FTSE 300, and just sort of having that beyond the US is really important. Signal. I'm a Canadian boy, so I was born in Toronto. I'm American now, but was
good for you.
Dual citizen.
We're stuck here. We're stuck here with the big 6 banks, and we love them. We love their monopolistic behavior. That's what we like. I'm joking. I have a question about the process, and maybe Sorry, I'm kind of a bit new to that. But in the RTAs that Keith and the team publish, i- is it normally like a trade? Is it it has a horizon of 3 weeks, 4 weeks, or it's a I think my thought is also invoked by a tweet you had today about the fact that you took too short of an option or something like that.
Oh, me, yeah.
Yeah, but I want to know in general, does the RTA, is it
That
supposed to be a short term, a trade type of horizon or longer?
Yeah, yes. I mean, yes and no, right? So just for full transparency, that short-term trade option had nothing to do with any RTAs. That was me being an
Okay.
idiot on the S&P and putting on a put option like midday when anyway, it doesn't matter. But
Okay.
yeah, I just screwed the pooch there. I should have waited till the close, and so and because anyway, yeah, I don't need to get into
But
what I was.
let's
I don't need to get into what I was doing. But basically, let's go.
no no
Let's talk
let's
RTAs.
consider the RTA on Amazon today, for example, right?
Yeah,
As an
yeah, yeah. So
example.
if you
So
pull that out, you'll see there's a column there for duration, and we talk through like trade, trend, and tail.
yes.
So that is so that is again kind of like our that's the communication in terms of like, hey, this is something where we're short and we're kind of short this, or we see this kind of
Oh,
transpiring over that duration time frame. But RTAs in general are much quicker in terms of, or can be quicker in regards to kind of they're definitely more on a trade duration or like an immediate term
okay.
price action. And really it's Keith helping to showcase and sort of communicate to Hedgeye Nation sort of what inventory out there amongst all the thousands of ETFs or hundreds of whatever, like thousands of companies, what is at the top end of the range. Again, I'm talking shorts
Yeah,
here
I
because you
know.
mentioned Amazon. Like what's at the top end of the risk range? What's basically great signals, top of the range, and where he would where he's communicating, taking executing in terms of a timing standpoint, when that should happen, right? So yeah, that's kind of the RTAs.
Yeah.
Yeah.
I think no, I know, but in the email I see here coaching notes 1, 2, 3, and so on,
Mm-hmm.
and then KM under it says duration, and there are three red bars. Is that
Yep. Yep.
what it's supposed to say?
Yeah. So
Okay,
that's the trade, trend, and tail. So trade is 3 weeks or less. Trend is 3 months or more, and tail is 3 years or more.
but all of them are red.
Yeah, yeah, yeah. So that's the duration. That's the long. That's like the general duration for that. Correct.
Mhm.
Yeah. But like this is yes. But again, I mean that Amazon might he might cut again if we're down on CPI day. Well, I'm just making it up, right? Like if he sees something change in that signal within Amazon, he'll either cover it, even perhaps at a loss, depending on what transpires.
Quickly, yeah, I
Yeah.
got it.
Yeah. Yeah.
Okay,
Cool. All right, well, we're pushing up on kind of an hour here. I see a few new faces out there. Turtle Cap, I see you out in the crowd. Welcome, my friend. For those that haven't been paying attention, he and Jimmy Runs Money, they started they started a little bit of a podcast. I said that twice, Turtle. I'm sorry. They started a podcast series via YouTube, and you won't believe it, but the Cali boy from aka Turtle Cat, is the beautiful blonde-haired boy. So anyway, it's a good little video series. They launched episode 2, I think, over the weekend. Turtle, I saw it, and so go check those guys out as well. Jimmy Runs Money obviously speaks up here quite frequently, so just want to give those guys a quick shout out and that kind of thing. They're both advisors building their business out in the West Coast. So Turtle's down in Southern Cal, and Jimmy moved up to Pacific Northwest. But anyway, just wanted to shout those guys out. They've been big friends of the program for a long, long time, and that kind of thing. But why don't we open it back up? If anybody's got any other questions in the crowd, commentary. I know we've covered kind of a lot tonight, kind of as we push up on this hour mark. Otherwise, we can kind of keep it tight. Palmer's probably working out. Leslie, I see you out there. I mean, so many, Tim. Anyway, lots of friendly faces. Appreciate y'all. Anybody that's going to be in Miami, I am flying in on Sunday afternoon, going out Wednesday afternoon. So anybody that's going to be in Miami on January 24th for the regional conference, just like in Dallas, we will be kind of getting together, a bit of an informal component there for kind of breakfast and that kind of stuff on the Wednesday. Sorry, post breakfast, but it was a really great conversation we had after Dallas. We kind of got together and talked process. Talked in that case, it was sort of focused on some options trading from existing subscriber, that kind of thing. So really good conversations there. One of the best parts about the regional conferences is getting to meet like-minded folks, like folks in this space is called, but in person and sometimes over a cocktail or over coffee, that kind of thing. And really just talking through process, talking through everything about being trustworthy, accountable, transparent, executing in the market, et cetera, et cetera. So they're a lot of fun. Tim, welcome, my friend. Speaking of Florida.
How's it going, Robert?
I'm good, buddy. How are you?
Man, I am halfway between El Paso and Pecos, catching a frac job and catching a notebook review. So
I love it.
Pretty good stuff, man.
I love it, buddy. I love it.
So one of the things we talked about intermittently, and man, it just keeps coming back as I look back at the way I trade and the way I see other people trade, or at least what they put on Twitter and other things. The difference between being right and making money. So the being right, the quads are the guide, and we kind of have a good feel for where this thing's going. The being right is the Hedgeye process is really good for that, and the RTAs help you with some of the tactical timing. But one of the things that over the last year that I've really identified is not getting sucked into my own narrative, but trying to be more dispassionate with the numbers. And the moments like these where the whole maybe on the open you thought, oh, okay, this is it. It's gonna do one thing, and then so you didn't cover some, and you didn't take some off the table. So it made reshorting the what was a pretty minuscule bounce today even more painful. So that balance between being right and making money, sizing correctly. I love a really robust discussion about sizing correctly, because you can't just do an even increment and just there are times to execute. Like today, was not a day to do nothing, and Friday wasn't a day to do nothing. But there are times when you should execute much more incrementally. So can you talk us through your process on how you do that, and maybe any feedback you've got from the Hedgeye team on how to press into these moments of maybe accelerated clock time in the market? Any kind of feedback you guys have there? Because that's one of the things as I looked back over the last year, I was directionally correct a lot. But timing makes a huge difference, especially if you're utilizing any kind of derivatives.
Yeah. And I'd love to open that. This is a great question, Tim. So thank you for setting up. I'd love to open it up to the floor here. We got plenty of room for speakers and that kind of thing. So anybody who's got some commentary around that. This should really go beyond just me, because I am just one person. Keith is even just one person in terms of how he executes his process. So yeah, let's get this conversation rolling. This is a great question, Tim, and certainly one that's very applicable tonight here. So Wasim, I'll pass the puck to you, and then I can give my 2 cents as folks come up.
Yeah, for sure. So Tim, you know what? This is something I've honestly been working a lot on, especially in the short side. It's it's all about sizing and when, right? Like when you short it, and then how much you short it. Initial position, and then incrementally. So obviously the basics is obviously like your mask, but But for me, what's helped me a lot is I built a kind of what I call a trading allocation calculator on Excel, and it basically makes it like mindless, so I don't have to think, right? So because there's so much to think about, and so this trading allocation calculator that I've built just helps me. It basically essentially defines all my longs, like longs, shorts within FX, fixed income, equities, commodities, single stocks, and then options, right? So FX being the biggest, options being the lowest, max allocation, and then my min and my max, and then I'll also I'll have like incrementally. So if I'm shorting something, like I typically won't short anything less than 25 basis points, and then nothing more than 50 basis points. But I want those numbers there, right? So depending on the pile that I'm playing with, I'll have everything kind of pre-calculated, and that helps me make decisions. It just helps me there, like just like quickly make decision uh, without having to like have any feelings or emotions about it. And because one thing that I used to do is like I used to get to max way too quickly, right? Again, I got the direction right, but if I maxed out too quickly, I don't have enough bullets for when I really need them on a day that I didn't think the market could go up anymore. And so that is something that has helped me like a lot, is just like focusing on how much incremental, right? Leave yourself enough bullets. That's a key thing, right? And so like don't just go willy nilly and just be like today feels like I want to go like I want to go 100 basis points or 200 basis points. Like you're gonna get screwed, right? And so that's just something for me that's helped me a lot. It's just having everything pre-programmed. Like that's all.
I saw Palmer jumped up, but I think we lost him. Excuse me. So so Tim, Wasim, that's freaking awesome, and I think that Excel sheet sounds amazing. So well done there. I think a lot of folks could leverage something similar like that to take the guesswork out of the equation in regards to here are my defined rules, right? And then here's how I execute.
Robert,
hey, Palmer, are you there, buddy?
Yeah, I'm here. Can you hear me okay?
Yeah, I can.
Yeah,
Absolutely.
I was going to comment a little bit on that. I have very similar
let's do it.
approach to what Wasim was talking about. I just call it my Excel trading tool, and what it does is I have all my sectors broken down on it, and I use bridge bands on positions that we don't have risk ranges on, and it actually will calculate the positions. Well,
hey, Palmer, do you use those inside TradingView primarily?
No, I use Thinkorswim.
Got it. Okay, so
and then I manually populate that sheet every day with either the new risk ranges from Keith or the bridge bands, and then I use multiple different oversold and overbought indicators that kind of help me decide when to buy. And that the Excel tool calculates the location of the position in reference to the risk range. So then I have a basic rule for how much I'll buy of a position. So like if it's a long and if it's fully, what I view as fully oversold, and it's within about 30 to 40% of the bottom of the range, then I'll buy just 25 basis points. And as it gets closer, I'll increase my purchasing size. So if it's within just 10% of the bottom of the risk range, it's 50 basis points. And if it gets all the way down to the bottom or breaks through it, usually I'll buy 100 basis points. And then that Excel tool also calculates the max position sizing, and it also tells me what a 25 basis point purchase is. It also tells me what 15 basis point purchase is, because there's times that I'll just barely touch a position. And that kind of keeps me within some general rules, and sometimes I don't follow my own rules and get myself in trouble, but that's usually the way I approach it. And it does, as Wasim said, it really does take some of the thinking out of it. It becomes more mechanical and in nature. You're just following a rules process. You're not really thinking as much. So.
No, that's helpful, Andrew. So you're using the bridge bands and position and range to give you a clue as to when to press. Are you using any other indicators on when to really press more aggressively a position? And then on the flip side, when it reverses, when to take it off?
I don't touch it until either my oversold or overbought indicators tell me that it's fully one way or the other. The directional change is sometimes one of the things I've kind of struggled with figuring out exactly what to do. Sometimes things just move against you. That's something I'm still kind of trying to hone a little bit, but haven't quite polished that off yet. So.
Thanks, Palmer.
Does that make sense?
Yeah, that absolutely makes sense. I appreciate that, Palmer.
Yeah, and so what I'll add there is I think patience, right? It's like easy to say patience, but sometimes meetings can be your friend, right? In terms of getting caught up or traveling, right? Like you, Tim, right now, you're traveling. It can be your friend. It can cause you to be away from the screen for a little bit of time. So that you're not sort of just staring there trying to be like, I don't, basically, in your head going, I don't understand how we're, pushing towards the top end of the range. I'm going to execute, right? So, again, just anecdotally, that's basically what happened to me today. I missed sort of covering some puts that when the S&P went down to that 386 range, and then I came back, got out of my meeting kind of around noon or whatever, and missed it. And then I was like, shit, okay, I got to figure out what I want to do here. So rolling those and just being impatient, right? So, just kind of understanding what option, well, again, on the derivative side, like what options are do you have in the portfolio, right? Are they, zero dated, 3 days away, 13 days, 10 days, 64 days, whatever it is, right? And just kind of understanding why you're getting into that position. What's the point of leveraging those, right? Keith talks about this all the time in terms of kind of the rank order of things, right? So going, shorting the underlying security itself first, and then using the derivatives to augment that position rather than going, directly for those, those derivatives. I think if again, Tim, I'm not saying that you're, because I know you're not new to options trading, but for anybody that's kind of listening in.
But I am a complete
sort of
degenerate, so those two things offset each other.
Exactly. I've joked many a times that I think if I ever create an ETF, it's probably going to be degen. But yeah. Anyway, that's a whole nother conversation for another day. But so the derivatives, right, in terms of what you're, what are you trying to accomplish, leveraging those and that kind of thing, right? So, I think everybody in terms of, making, being right and making money, those are two different, that's something that's very easy to say. Sometimes a lot of patience is can be very challenging to execute, right? So, that's what I kind of do. Just it's not really rule of thumb, but for instance, on Friday, right, you get that kind of first move higher. I dip my toe in incrementally there in regards to, whatever action I want to do, right? So in this case on Friday, I was shorting, but maybe it's, the reverse in a quad 2 environment, and you get sort of some, VIX spike with volatility spike, and you want to be buying, right? So,
right.
What I often do is I kind of wait, skip a day almost, right? So I did very little action actually yesterday. Man, it's I keep thinking we're Wednesday. I guess it's because we normally have this call on a Wednesday. But so yesterday I did very, very little, and really kind of got much more aggressive into the close, kind of at the and again patiently. And I got lucky today too because I had a bunch of meetings. So in the afternoon I really was away from my desk from kind of 12:45 till about 3:00. So yep. I came back and I saw what was happening on the screen and really kind of just sort of patiently kind of, dip my toe in kind of, going in that last sort of 20 minutes of the trading day, which again, we'll see what transpires there. But, that I think can be, there's a whole kind of three day rule type thing that a lot of folks might talk about. Again, we're much more kind of math and data driven. So, I know we all leverage the risk range and that kind of thing. So, Keith says it all the time in terms of, when you when you least expect it, you'll get the top end of the range or the bottom end of the range.
Yeah.
And I think that's like really, really critical. And when you're using the derivatives, you really want to try to have those extreme moments, right, and take advantage of them.
Right.
And I think that's something, again, that I'm trying to, again, I mentioned this last week, and, Jimmy asked, what's sort of something that you're working on in 2023 from a resolution standpoint. And for me, it's options trading. I fucking suck at it. It's like, and so, and it's something where it's like, I just should be a lot better at it because I understand the mechanics. I get how they work. I just freaking stink. So I need to keep going through the reps and keep going through all that kind of stuff. And again, like exactly what I just talked about, staying patient and using the options really for those extreme moments, like Palmer just mentioned, in terms of like that oversold, overbought situation, and same with Wasim, and kind of using those as that kind of like last resort, or like, holy moly, can't believe it, we're at 39.19.
No, that's helpful, and options are tough but depending on whether you're using them to express a trade, trend, or tail view, your opportunity to catalyze a gain can be really short, and if you in second down in Tim's notebook of lessons from 2022 is, if you have the gain, take it. Because especially in an options trade, the way we're in the chop bucket, right? So you should expect, if you see the bottom of the range, that you're going to pretty soon see the top end of the range. So you better catalyze your gains.
Yep. That was the other thing. I get so mad because anyway, we don't have to go into this doesn't need to be Robert's like fucking bitching session, but I was up like 30% in the close yesterday in that option, and today, thinking that was a hot shot, I just let it roll.
Yeah.
Anyway, it doesn't matter. A
little bit of a theta burn there, Robert.
Just a smidgen, Tim.
I feel your pain, man. I got some Nomex. I'll send it over.
All right, perfect. I appreciate it. Perfect. Anybody else out there? Tim, that's some good question. I think, again, the timing, the sizing, and I talk about this a lot. It's something that's very, very, it's probably one of the hardest, the hardest thing out of the gate is getting up to speed in terms of just understanding the process, putting in the time and the effort, and the continuation of that time and effort on a weekly, daily basis. But then when you get up to speed, I think that the timing and sizing of those positions is the kind of like next phase in terms of, quote unquote, pain points, right? Because, even on the sizing side, right? Like, if you're incrementally, or if you're at your max right now, going into the close today or close to it, it's like, what are your options, right? In terms of, okay, if I'm at my max, and I'm at my max kind of like, net short positioning, it's kind of, the only way to change that is to either, buy an underlying asset, right? So like get longer your longs, or cover some of your shorts. And Tim, I think it might have been Palmer, or I can't remember who said this, but covering your short kind of earlier in the morning, so you free up some capital or free up some room into from an execution standpoint. I think, again, like that goes to just understanding what's inside of your portfolio and your current positioning. And for me, that transpires kind of like in the evening, or really after the close, right? I spend kind of 30 to 45 minutes just going through the positionings that I have on to better understand kind of like the portfolio construction and makeup, and where I need to maybe pivot, right? So if like a signal, so for instance, like consumer staples is a good example, right? XLP put in a lower low this morning, and that's one where I got more aggressive on my sales in the last couple days, because I was much bigger coming into that than I really wanted to be, right? So I was sitting at about a 3.5% position on XLP, and I really wanted that significantly smaller, just because of the signal strength that I was seeing, and sort of some of that lower low to me is a first mover kind of, or sorry, not first mover, but is a first move indication, I guess, of sort of just a little bit of signal weakness happening. And so I just wanted to be conscientious of that, especially given the other components of things like fixed down at the low end of the risk range and SP at the top of the range, et cetera, et cetera, et cetera. So I think all those kind of play a factor. And sometimes you got to augment, like if you, to Palmer's point, if you sometimes, sell typically at 15 to 25 basis points, sometimes depending on your positioning and what you're seeing in the signal, you got to kind of alter that and factor that in terms of what you're doing inside the portfolio to get better construction within it.
Okay, Robert.
Yeah.
I have a comment about the options. We talked so much about it.
I don't know if I'm the right guy to answer your question, Signal.
No. But that's why there is so many people here, right?
Exactly.
Somebody will.
Yeah, we'll crowdsource this bad boy.
Yes. My point is, we mentioned before, let's take it the RTAs, right? They are normally trade, 3 weeks, 4 weeks, something around that. And Keith talks a lot about options being a very small part of his portfolio, 0.5%, 1%, or whatever, right? Very small. But could you not express? Let's talk about an RTA now. Express an RTA in terms of options. Why is it like such a small percentage? You could, for example, the Amazon RTA that we got today, sell at 89, something like that. It was right. You remember at 3 o'clock. You could express it as say a put spread over 3 weeks. The spread being the width of the risk range. I mean, that's just a way to express something. That's my comment.
Yeah, absolutely. I mean, I think so. From a sizing standpoint, just so you're aware, that percentage sizing is per asset or per security, right? So it's called 50 basis points of capital for Amazon in this example, right? So that's the sizing side. And the reason for that is because the volatility component, the underlying volatility component is incredibly high within an option, right? So, but yeah, I mean, I know there's many folks here that, I see John Weeks out there, and he's a good buddy of mine, and I know he plays options all the time. There's many here that do it, right, and express RTAs in some, sometimes in some way, sometimes via the derivatives market in that regard. So yeah, no, you're definitely, again, it's all about kind of what you're comfortable with, time horizon, risk profile, all that kind of stuff, right? This is where, Hedgeye is about giving you tools and helping augment your process so that you can execute at the highest level for your portfolio and what you're trying to accomplish. So I think that's about it.
Yeah,
I'm glad. Yeah.
That's my process.
Totally.
In some ways.
That makes sense. It makes sense. X2, welcome, my friend. I see you jumped up as a speaker.
How you doing, Robert?
I'm good, man. How are you?
Hanging in there.
Good.
So I got a question for you.
Let's go.
What would you say, in your opinion, is the ticker that is closest to changing trend? Either from bullish to bearish or bearish to bullish.
Sorry, X2. Could you repeat that, buddy? I lost you. My headphones actually died. So sorry about that, man.
Oh, no problem. So the question is, which ticker, in your opinion or your signal or whatever, do you think is the most likely to change trend the soonest? Either way, bullish, bearish, bullish.
Yeah. So I think what was, and I don't know if you were on earlier, but I'm paying very close attention to the DAX risk range that we get every day, where it went neutral yesterday for the first time. I'm very interested to see where, when that pivots to either bullish or perhaps goes back to bearish. I think Europe in general, especially what we're seeing again, a lot of the setup here is somewhat dependent on the U.S. dollar and it getting off its ass, and or / aka holding trend line, which it is doing. and and because in a quad 4 environment, the dollar is one of the, is a key driver of a quad 4, right? So I think that to me, and what's transpiring with sort of the euro and where it keeps probing the top end of the risk range, holding trend, right? So remains bearish trend there. But that component where DAX went neutral, I think it's kind of interesting, and where it the inside, like if you kind of look at what the makeup inside the DAX, right? There's just some components there that I think industrials, for instance, is basically has been a leader, kind of in regards to. Hold on, let me just pull it back up so I'm not misquoting. XLI is up 2.63% last week, 2.44% last month, right? So industrials, materials, those again, those have had near term or immediate term sort of bounces, and really kind of has been pretty strong in the last sort of couple of months. And anyway, so the DAX to me is one that I'm watching very closely.
All right, cool.
Yeah.
Appreciate it.
I think the other one too, sorry, just to expand on that in terms of US, and I know you kind of focus a decent amount on the US side. I'm really interested to see kind of what transpires. We're getting, again, like I mentioned, the consumer staples lower low, right? I'm not saying that's going to move bearish trend at all, but if we get some increased vol component, what does that look like from a U.S. equity standpoint, right, across the board? Do we get back into a situation like we saw in, call it Q2 of last year, where we really had very little that we can invest in? And do we get a situation like that again, or do we get a continuation of a quad 4 environment where you have components within multiple asset classes that remain investable, right? So that's a piece too. Again, if you kind of think a little bit further out beyond just this immediate term, and kind of, okay, let's think about what does VIX look like at 27, 28, let alone 32, right? And what does the portfolio construction look like in that environment versus where we sit here at 21? Because we've been lucky that we've been at the low end of the chop bucket for quite a while, in the VIX, right? So, it's been a minute since we've had to deal with even just, last month the top end was around 25. So it's going to be interesting.
That's for sure. Did you see one other thing I sent you on your DM, that tweet about the volume and the Qs today? I don't know if you saw it.
I haven't actually had a chance. I didn't see it yet. No.
It just says there was only one day last year with lower volume than today in the Qs. And that was
I saw
the day
somebody
after Thanksgiving. I mean,
that's amazing. I saw somebody quote today that the volume was equivalent to like basically Christmas week or something, or like the day before Christmas, like the 24th, or not the 24th. It was the 23rd, I guess, this year, something like that. So I knew, and I was seeing volume. I mean, volume was like abysmal, but I didn't realize it was that bad.
Yeah. Anyway, just pointing it out.
Yeah.
Anyway, appreciate it.
Yeah. So that was a very long-winded way of saying Europe.
All right.
Europe and the dollar. I mean, the dollar is really going to drive a lot here, right? Yeah. So, it's interesting. Yeah, we're in an interesting spot with the dollar.
Yeah, tell me about it.
I know you play the FX market, so, but yeah. Again, I said this earlier, but for anybody who's kind of new, that low end of the risk range today was definitely one to be circling on the dollar. That's the first time it was below trend. So definitely
102 handle. Yeah.
Yeah, exactly. First time. So definitely something to be paying attention to. Yeah. And then the big lower high in China too. So.
Yeah.
Perfect.
All right. Thanks, Robert. Appreciate it.
All right. Absolutely, buddy. No, appreciate you. All right. So we'll, maybe one other question. If anybody's up here on the panel, if anybody's got anything on their brain, or in the crowd out there, I know we've got a few new folks. Otherwise, we can kind of wrap it up. I think we've touched base on pretty much everything I wanted to talk about. X2, that was a good question, though. Oh, sorry, Tim. Go ahead.
I was going to say, if we're going to finish off, if we're going to be completely degenerate, we need to come up with all the good reasons why you should go long natural gas into this terrible chart.
I don't even. So Tim, you start off with a really, really good question. I don't even know if I can. I mean that. I just can't. I mean that signal is so bad right now.
It's terrible, man. It's terrible.
It's so bad. It's so bad.
And for all my brethren in the industry, man, I want it to go up, but it's not going to happen. At least not right now.
Yeah. Yeah. And yeah, anybody who made money on cold, aka the inverse ETF of that, I'd be taking some profits if you haven't already. But it just keeps probing low into the risk range. The good news for me in the Northeast is we use heating oil to heat the house, and that's luckily kind of come down in price a little bit too. So not that they are correlated whatsoever, but just in terms of heating your home with nat gas. Yeah. Anyway, but yeah, natty gas. The copper again. I mean. We kind of talked about this earlier, but copper is a bit of an anomaly. Again, there's a lot of narratives out there about China demand, blah blah blah. I hate narratives, as you all know. But all I can say is, signal moving to bullish trend. That happened last week. What day was that? Maybe the 5th? No, it might have happened. Anyway, it doesn't matter. But it's been bullish trend for about a week or so. Yeah, that's one that's certainly standing out. X2 in terms of this is something looks a little bit different than the others, because commodities in general, again, if our outlook is quad 4, commodities across the board really should there shouldn't be really many, if any, in bullish trends. So it'll be interesting to see kind of what transpires there across the board. All right, well, another great conversation tonight. So thank you, everybody, for joining in on a bit of a quasi-impromptu evening. But thought that was a pretty great session, as usual. If I have time, we might do a double episode this week, either tomorrow or Thursday. I'm thinking maybe Thursday night. We do kind of another episode, do a double episode this week, post CPI, see how things stand going into Friday. But, beginner's guide's a lot of prep. So it kind of depends on how productive or how prepared I am for a beginner's guide on Friday morning, to be perfectly frank with you. So let's put that as a little TBD. But beginner's guide is at 11:30 on Friday. And I'm actually going to be sitting down with Andrew Friedman, our sector head for communications, on Thursday in the arena, also at 11:30. So we're going to be going through kind of his coverage list, his process, that kind of stuff. Should be a really good conversation. Going to be doing those regularly on Thursdays here moving forward at 11:30 with different sector heads. So look for more of that. It's going to be a lot of fun conversations. I know Freebird's been on here on Spaces pretty regularly throughout, from the beginning. We all love him here within, we love all of our sector analysts. But so it should be a really fun combo on Thursday. And then, as I mentioned earlier, Miami Regional, January 24th. If you haven't gotten your ticket yet, highly recommend it. It's a lot of these type of conversations. I met Tim in person in Dallas, and many, many others there in Dallas, and certainly Hedgeye Live back in May. But phenomenal conversations across the board. I see David Salem's out in the audience. What a pleasure to have him listen in. And, he was, we were speaking this week. So I look for, really looking forward, post, I think, Trend mentioned last week, trying to have a conversation with him. So that looks like that's going to be happening at some point here in the near future. So really excited to get, a bit of a one-on-one with Hedgeye Nation with David Salem very soon. So lots of fun stuff happening here. And appreciate everyone's time and energy and all the conversation this evening. So appreciate it, guys. Thank you very much, and we will rock and roll soon.